is regarding our second quarter 23 strategy. The title of our report, we're probably going to issue it on Monday. So what we're just trying to say is being more patient than the Fed. So the basic thesis of this is that although the Fed is still raising rates, although because they don't see economic conditions slowing, neither do they see inflation slowing down. But for us, we are more patient. We do see real-time data suggests inflation is coming down and global growth is definitely slowing down. So we are like, when we say patient, it's like that relative that you always give a stock tip today, then tomorrow they ask you why the share price never go up. But we want to be more patient than what the Fed does. So in terms of the disclaimers, so again, I know most don't really read this, but let me just say that this is for educational purposes. I too have to read this. This is basically our opinion. We rely on third-party data, and also we do not take into account your specific investment objectives, and do refer to your financial advisor for more to meet your specific financial needs and objectives. Obviously, I didn't write this. So okay, as usual, we'll just run through what happened to the Singapore market in the first quarter and all the various assets. Okay. So so this is basically the performance of all the various asset classes in first quarter. So on your far left, that's our Singapore market. Yeah, it didn't move anything; it just went sideways. Just for your reference, this in US dollar. The real in Singapore dollars, I think the market was just by 0.3. Then if you refer to, so what performed well this year was actually the Nasdaq, which was surprising. I think the Nasdaq is up because the big tech stocks did well in cutting jobs, and also the other thing was there's a lot of hype now on AI, so maybe that's one of the reasons why the Nasdaq did well. Last year, the blue color basically means the performance of all these asset classes in 2022. So of course, Nasdaq collapsed tremendously, and yes, you're seeing this recovery. What was the other asset class that did well was, of course, gold, which we'll talk a little bit later on, because we usually do get questions on it. What didn't perform well was commodities. So the strange thing here is that usually when global growth is stronger, commodities should come up. But this time around, the cyclicals, there's a bit of divergence. So what we're trying to say is that Nasdaq is supposed to be a growth index that went up, but commodities didn't go up. So we're just implying that maybe global growth isn't that strong. But again, this is purely for your reference, to see what did perform. And most of these are ETFs, so you really can buy into this underlying performance if you're interested. So the next is, we're just going to take a snapshot of some of the stocks that did well. We always focus on banks because on the index, the banks is almost 40%, so it's a core component. So the banks was basically sluggish. Of course, we know what happened to DBS recently. I try not to make any joke about it. But, then the other thing is, the one that performed well is on your top right. So conglomerates did very well. I think Sembcorp this month, March alone was up 20%. In part, of course, they have renewable energy, and renewable energy does well when you have right now the energy prices is rising. And in a way, renewable energy for most portfolio managers could also be a hedge, because if you get caught out by rising inflation and interest rates rise, at least renewable energy will benefit, because if energy prices go up, inflation go up, they can sell their renewable energy at a very competitive price, because the sun is basically free. Or what you face is basically just fixed assets. The surprising thing for us was that Sembcorp did well in their conventional, that means the usual energy in Singapore. In part, we think also because they had a lot of excess gas to sell. And when what we saw in Ukraine, when gas prices spiked up, they had extra gas that they couldn't use, so they managed to just sell that off and with huge gains. Capital Corp did well, so the conglomerates. The worst performers were ones on your bottom right. The REITs on your far left. So REITs did well, and we think tactically REITs is what we favor right now. On your bottom right, some of those that did underperform, of course, Yangzijiang was a strong performer last year, and this year is different because Yangzijiang is a shipyard for those who do not know, and there's really not many opportunities out there now for them because container rates have collapsed from 10,000 now to 1,000. So the containers are not ordering. Dry bulk is also going sideways. LNG, is another vessel that they took on orders, but there's no capacity for LNG. The only avenue for them to take on orders is mainly the chemical. So out of 4, only 1 is doing well. So that's why the orders for Yang Zhejiang is going to come off. So maybe that's why investors are a bit more negative. For CDL, we're a bit surprised because we think property is not as robust as last year, but we're still going to be resilient. But anyway, no, we don't want to delve too much on our past. Let's go through on some of our macro themes. So we usually like to give every investor a macro theme. What we mean by that is that as you're investing, these are some of the themes, these are some of the macro events happening. We promise you we're not going to talk about GDP because there's really no purpose by telling you the GDP is up or down, but so what, right? So we're just going to tell you, sorry, we only have one GDP chart, but we're just going to tell you basically what are the themes that as an investor that you should be aware of. Whether you agree or not, but at least these are the things that's happening. So the first thing is that we think inflation is going to drop. So that's very important as an investor because inflation drops faster than expected. What it means is that interest rates are going to come down. So why do we think there'll be a sharper fall in inflation? So if you look at real-time data, because of course the Fed looks at the CPI, which is the rate line, that lags. So as you can see, commodity prices and CPI, which is your inflation, moves quite in tandem. But what you can see that commodity prices has totally collapsed, but inflation is still taking time. So what we're trying to tell you is that the real-time data for commodity and inflation is coming up sharper than expected. So do expect your CPI and inflation to continue to drop. And that's important because that means that there could be some cap in the ability to, there's no need for the Fed to kind of raise interest rates that much. Another real-time data that we look at is also rental. This is a bit unique to the US. I mean, for us, it doesn't really matter, but for them, like almost 40% of the index could be shelter and rental. Okay, so that's important too. And the real-time data for rental is also dropping. But you can see the red line, that's what the Fed is looking at. So the Fed, rental is still rising. But what is happening in the US is that rental is collapsing very fast. So you should expect the red line to come off. So that's what I mean by we're just trying to be more patient than the Federal Reserve. Okay, anyway, this is the last slide. I'm not going to talk too much on inflation, but this is another real-time data. So we rather like to look at real-time data than look at the CPI and to tell us because it's a bit lagging. So another real-time data is transportation costs. So this is the cost. This chart is basically the cost to ship from, the blue line is to ship a container from Shanghai to the US. So it used to be maybe 1,000 plus, then of course they had a good time. The thing spiked up to maybe 10,000. Then they order a lot of ships from Yang Zhejiang, but of course you can see what's going to happen now. So obviously they're not going to order any more ships because the rates have totally collapsed. So I guess you ship anything from Lazada, so that should be cheaper. I mean the shipping cost, but but compared to pre-pandemic, it is still up. I mean, it's not a very important data point, but compared to pre-pandemic, it's still up maybe 10–15%. I mean, not that it really matters, but you can just see that all these inflation pressures are starting to ease. Okay, the other thing that we think might be the US recession. So for us, our model for US recession is, we think our probability models is about 60%. And how we came up with 60 is actually mainly because when my yearly appraisal comes up, my boss is going to ask me, do you predict recession? I say, yes, 60%. If there's no recession, do you not predict? Yes, I still didn't predict because it's 40%. So that's how we came up with a probability model. It's a very scientific, we can share with you the model later if you need. Okay, so one of the key indicators we watch is actually the yield curve. Okay, we always get worried, people may not understand, but what it just means, instead of 10-year, 2-year, you can just think of it like we always say, there's a fixed deposit rate. Like your 2-year deposit rate is lower than your 6 months. So it only means that people think interest rates are coming down. And it's a very good indicator. It's better than any economists out there. So it will normally invert, that means it go negative just before a recession, which is the beige line. Okay, so that's why people get worried, because not only this indicator, but other indicators all point there's a recession coming. So you either say this time is different, which nobody dares to say that, or there's something brewing there. So what we just think that there's a high likelihood that US will undergo a recession. We already see it in manufacturing. We think there is a recession, but it's happening right now mainly in the manufacturing sector, which we'll touch on a little bit more. So this is a survey. So they just go to all the managers and ask, hey, are you getting new orders? Of course, going up means good, but coming down is really bad. And you can see it's down quite sharply. And to get some real world data, because all these are surveys, like we always survey, that we like to support certain things, but whether we like it or not, the survey you can lie. But for this, you can see the imports from the US. So these are containers that go through the LA port. So when China want to export stuff, you go through this port. Of course, there are a few ports, but we're just picking one. So you can see that the blue line, which is the growth. So the exports, the containers coming into the US are dropping almost 30% year on year. So basically, the manufacturing is collapsing pretty sharp. And when we do meet a lot of electronic companies, I think 9 out of 10 tell you that the orders are coming down. We'll elaborate later what the feedback they gave. Okay, and one of the problems the US has is because of this chart. So they have just too much inventory. Last time that we always highlighted, there was just, I think you've heard about this many times, but used to be just in time, you need to have Excel. Then we went to just in case. Now just too much, just too much inventory. So this is the amount of inventory that is in the US. They usually, so when the pandemic happened, it was already an increase to about 600 billion. Now you just spiked it up to 700 billion. So most exporters, if you know any exporter, maybe not the right time to pick up their call because now things are not so great. But if you do speak to them, they will tell you that exports are down, especially furniture and all that, because there's just too much inventory right now because they over-ordered. And of course, consumer spending in the US now shifted from goods to services. So we think there is some form of recession, but it's mainly concentrated in the manufacturing sector. Okay, but the thing is that, recession, I think you probably heard about it, I think 6 months or even more than a year ago. So what we think is that this is basically the US market, and again, the baseline is always the recession. So what we're telling you is that from peak to trough, that means from the market that are very high to the current levels or to the lows, if there is a deep recession or like what we had in the global financial crisis, the market can drop as much as 50%. In a mild recession, in the 80s or even in the 90s, it might drop, maybe mid-teens to 20%. So, but right now the US market is probably down about 14%. So what we're just trying to say is that, again, this monthly data, you can do weekly, daily, if you have a lot of time. If you have a lot of spare time, you can do daily, but we just did monthly. So what we're just trying to tell you is that the market has already factored in some of this recession risk in a way. So even if there is a recession, you might be thinking maybe 4 to 5 percentage points drop. Because the market is really well known. You read newspaper, you have to take a newspaper last 6 months ago, they've really been talking about it. So even if there is a US recession, if it's a mild, then you think the market at most is probably 4 to 5% drop. Unless you're thinking of a global financial crisis and something really deep, which we don't think, because even we had the bank shock and it didn't really hurt the US economy that severely. So that's why we think that has already been kind of priced in. And of course, the other thing, just one last thing, I don't keep on talking about recession, everybody's so gloomy, but is that what the Fed is looking at is always jobs. But the problem is that jobs always is a lag indicator. So if you look at this chart, by the time the Federal Reserve tells us that jobs are bad, we're already in the recession, it's a bit too late. But anyway, it's like reading yesterday's newspaper. But so if you look at this chart, whenever unemployment rate spikes up, that means the job situation is really bad. A lot of people are not having jobs. We are already in a recession. So by the time he reacts, it's already too late. So that's why it's a well-known fact that unemployment is a lagging indicator. So for him to wait until employment gets bad is a bit too late. So, but we think the real-time data is already kind of weakening, especially in manufacturing. So the other theme, just another few more themes. So the third thing we think is that the Fed can't raise rates is firstly just to get an update on where interest rate is, where investors think interest rates will trend. So this is not my prediction, mine is probably wrong, but this is where the futures market thinks. So the futures market think that there may or may not be a hike in May. So 13, because usually a hike is 25 basis points, which is 0.25%. So 13 means they're undecided, not just like 50-50, flip a coin. So what it means is that that the market thinks that by year end, the market is probably going to cut by 50 basis points, and even the Federal Reserve thinks interest rates are coming down. So again, this is just to give an update that a possible cut in interest rate, the market thinks is probably in July. But anyway, just to get back to the team again, so this is what happened to Silicon Valley Bank. Yeah, I think the news on this has been like squeezed until like some dry sugar cane. But let me just brief everyone what actually happened for Silicon Valley Bank. So the rate bar here is basically deposits. No, you just think of it like a bank, like let's say DBS. So over 3 years, their deposits grew 3 times. So imagine like DBS deposits about 500 billion right now. So over 3 years, assuming DBS deposits got like 1.5 trillion. I mean, it's like, but so when you have so much deposits, what do you do with it? So they actually didn't do the wrong thing. They took the money and they put it into government securities, right? Because it's government, so there's less risk and it's liquid. But the problem was all that 117 that you see there, the government securities collapsed. So that dropped by 14-15 billion of losses. And the problem was they only had 14-15 billion of capital. So of course they got wiped out. But I know this is a bit complicated here, but of course the investors weren't worried because these were held to maturity. What it means is that you don't actually have to recognize because you're going to keep it and only when it matures you sell. But you only start to worry when depositors run away, then they want their money back, then you have to sell all these 117 billion. So it wasn't a problem until depositors sell, then you had no cash. The only cash you had was 14 billion, and one day they took away 40 billion. Then you know that if you sell the 117, the securities, government securities, bonds, or that, your capital is going to be all wiped out. So that's the reason why what happened. Just to inform everyone, it was because they just had too much deposits and they had to park it and they lost because of the government. So the other thing that's happening is that the other sign of stress right now is also that the US banks are borrowing from the Fed. I won't run through this kids, but just for your reference. And okay, so the two things, reason why we think the Fed will be very mindful to raise rates is that if they keep on raising rates, then like we show you the earlier chart, they will continue to recognize losses on the government securities, right? Then you raise the risk that there could be another run. And then the other thing is that the bank lending standards in the US, this is before the recent bank credit. This is basically a survey of all the banks, whether they want to lend or don't want to lend. Go up means they do not want to lend. Actually, it means tightening. It's not a good sign. So, and this is before the recent event. So what we are trying to tell you is that with all the banks will want to keep as much cash as possible, which means they're going to restrict lending. So this is going to tighten the credit lending standards. Sorry, it's a bit complicated, but what it just means that the banks aren't going to lend because they want to keep as much cash and deposits as possible. Okay, then this is my last slide on this. So what we're just trying to say is that the worry you're going to have is, of course, when the Fed cuts rate, we should all be celebrating. But historically, when the Fed does actually cut rate, which is the red line, the market doesn't bottom. That's the problem we're going to have. So when the Fed cut rates, which is the red line, you can see the blue line, the US market still actually continues to drop. When they cut again, the 2008, the market still drops. It varies. Sometimes 1 month the market will bottom, could be even 17 months, depending on how much weaker the US economy is going to be. So what I'm trying to say, yes, the Fed cut rates could be good, but it also means the market may not have yet bottom. So this is a food for thought. So just be careful what you wish for. Okay, okay, that's all for the US. As normal, we won't talk about US anymore. So now we just talk all about Singapore. Probably might have bought some of you. Okay, so for Singapore, what we see right now is that the export sector, this is the Singapore export sector, and that is where the weakest point for Singapore now. Because the red and blue line is collapsing. So this is the amount of exports for Singapore. The blue line is total exports, excluding petroleum. Then the red line is electronics. So that's why electronics is also going to be weak because you can see from the data here. But what is strong for, and okay, this is the only GDP data we have. So what we normally do is we use this so-called PMI new orders, and it has quite a good gauge into what is the GDP for Singapore in the second quarter. So what we do see is that GDP for Singapore is going to be quite stable. There's no recession risk or anything, but it's just going to be relatively stable. So for Singapore right now, yeah, I hope nobody remember that I said jobs is lagging either. But anyway, so jobs in Singapore is very strong. The red line here is vacancies. That means the amount of jobs out there for PMATs, managerial level and so forth. You can see it's record level, and the orange line is basically the vacancy to unemployment. That means for every 2 jobs out there, there's 1 person who's unemployed. So anyone who's looking for a job that's on paper, at least, it doesn't tell you the type of job, but at least on paper, there's two 2 or more jobs available for this particular individual. I think this is the best since 1997. And of course, vacancies is also dropping. Of course, that's why we say it is ample, but of course, slowing down. And the reasons why Singapore is doing well is because we got record foreign direct investments, tourism is opening, construction, we'll discuss about it later. And of course, the one that the unknown for us is really about population. So as you all know, we have the white paper. It's not a discussion whether we should hit the white paper or not paper, but we're just trying to say is that based on reading all the parliament stuff, but the government has a planning scenario of 6.9 million by 2030. So even if you took the low base, so this is the white paper, the high case is we hit 6.9 million population. The low case is we hit 6.5. The government is planning, I think, 6.9. But you can see right now, because of the pandemic, we were supposed to trend the low case. But right now, we are far, far below. By now, we should have around 5.9 or 4.8 million population, but we're only hitting 5.6 based on last year. So why is this important? Because if the government, if the authorities, shouldn't say that, if the authorities decide to push back up to the trend line, it's going to be good for the Singapore economy. It's going to be good for rental. It's going to be good for Sheng Siong. I'm just picking a name. So it's going to be good for the whole general economy. And of course, no one will explicitly whisper into my ear whether they try, but it makes obvious sense. If you're going to plan for the blue line, you should at least try to hit the red line. And because the other issue we have, we got the huge demographics. I think 1 in 4 will be 65 and above. So we need that population so that we can enjoy economic growth. Otherwise, there could be jobs, but there's no one to fill it. So this could be another structural tailwind for the Singapore economy. Okay, with that, I know you're all bored with macro, but anyway, with that, we're going to move to some more actionable ideas for my colleague, Zane, then we'll return back to sector and topics. Thank you.
Okay. So thanks, Paul. Good morning, everyone. So now I'll be going through giving you all technical pulse of the markets. Giving you all technical pulse of the Singapore market. So firstly, I'll be talking about the outlook of the Singapore market. So we can look at this ES3 ETF. So this ETF actually basically something actionable. So what it does is that it tracks the performance of the Singapore blue chips. So look at the general trend wise, right? I'll just show it over here. We've actually just been consolidating in this wedge over here. So this has actually been dating back since 2021. So it's actually quite a long time. And we can see that from the chart, right? We've been actually just tight. So we have actually just been tightening into this wedge over here. So recently, right, you can see after the sell down over here. So this is the weekly chart. So after the sell down that took place recently over here, we have actually just rebounded from this trend line uptrend support line over here. So currently, the support zone is around 3.15 to about 3.2. Resistance zone wise, I think we are looking at about 3.28 to about 3.32, which is currently the 50% to 61.8% Fibonacci retracement level over here. So for this upcoming quarter, right, we can expect some form of consolidation possibly in this tight range over here. Yeah, so that's a general outlook for the Singapore blue chips. Okay, then I'll move on to 2 of my stock picks. So the first one for the large cap pick I'll be covering is City Developments or CDL. So for CDL, we have seen that ever since it hit the 840 this resistance level over here, right? We have experienced quite a bit of a sell down that took place in this part. Currently, we are just consolidating in this flag pattern over here. So, but however, right, in the bigger picture, we are still in an uptrend. So when you look back, we have this main uptrend channel that's ongoing over here. So we are actually still inside this uptrend channel. So actually, this represents a possible good opportunity if we actually come to the channel support over here. So support is around $7 around there. So if this actually means with this 61.8% Fibonacci retracement support level over here. So over here, right, if actually price comes down to this level and see some form of bullish signals over here, you can consider a good entry over here. And then possible target is maybe in between this resistance zone at about $7.80. So the resistance zone is about $7.60 to $8 over here for now. So that could represent a possible upside of a bit over 11%. Okay, my another topic will be Suntec REIT. So for Suntec REIT, the trend, right, is quite nice actually. So we have actually came out from this downtrend over here in this stretch. It was mainly last year. Then currently we are actually transiting into this uptrend channel over here. So for Suntec, I see a confluence of three supports, which means that there's actually quite a few bullish support that's lying in wait over here. So at around the $1.33, $1.39 price level over here, you can see that it's the uptrend channel support over here, as well as it was a previous horizontal resistance back in December of last year. And then actually we retested this previous resistance that is a support in February this year. So if we do a retest over here again, that will be another horizontal level to look out for. As well as when you look at this swing over here, right, from 130 to about 146. The 139 level is also around the 50% Fibonacci retracement level. So that's why we explain that there's a confluence of three supports for possible entry into Suntec REIT. So for at 130, right, we can expect maybe to reach about possibly 155, which is the 61.8% retracement level here, and previous, you can see previous resistance back in the last quarter of last year. So that will represent about potential about 11.5% upside for Suntec REIT possibly. So that's all from me for the technicals. Pass on my time to Darren to talk about the sector trends, starting with REITs.
Thanks, Dave. So for sector trends, we begin with REITs. So we'll start with this graph. So this graph is the SREIT yield spread over the 10-year Singapore government savings bond. So you can look at the Singapore government savings bond as a fixed deposit rate, or rather a risk-free rate. But that's, of course, unless you look at like Credit Suisse, that's different story. But we invest in, let's say, Singapore, fixed is quite safe. So now we look at this right here. It's actually the yield spread is going back towards a 10-year average. So what this means that if the yield spread is below here, you are compensated lower for investing in REITs rather than the risk-free asset. So if it's up here, you are compensated more. So right now we see that this yield spread is actually heading back towards a 10-year average. So we think it's starting to be a good time to invest in REITs. And why we think and why we are overweight REITs now is because, as a technical standpoint, REITs, we feel investors will start piling back into REITs when there's a lot of global uncertainty in the market, and then investors will start looking at REITs as a safer play. So that's why we are overweight REITs. And we are not overweight REITs because we think that there's a lot of capital appreciation potential for REITs, for example, because right now there's still a lot of headwinds like a rising interest rate. I mean, it's probably going to peak soon. So if this high interest rate, right, as the REITs start to refinance their interest costs, we will see that the cost of all these REITs the borrowing costs will start to increase by, like, we're expecting about 4% on average. So last year we saw from the financial 22 results, right, a lot of the REITs, their average cost of debt increased slightly only because the interest rates only started increasing in the second half of the year. So when we see the full impact of the refinancing this year and maybe the next 2 years going forward, it will really impact the borrowing cost for the REITs. So that is the major headwind for REITs going forward. But we still think that is a safer play, as the prices of REITs have really adjusted downwards, and then which is why we see this yield spread going up, the dividend yield spread going up, and we think that it is a good investment now. But what I want to mention is that the yield spread going up is not because of a lot of the share price crashing or whatnot. It's more because the Singapore government savings bond has decreased. Like since the start of the year, it was around 3.3, but now the 10-year average, now the Singapore government, the savings bond is about 2.8. So the yield for the Singapore government bond decreased, while the yield for the dividend yield for SREITs has remained rather stable. So for this graph, it's actually the valuation chart. So on this axis, it is a price to book. and this axis is the dividend yield. So what we trying to explain here is that if you are trading around 1, it means 1 times price to book. It means that you are trading around your book value and your asset value. So it is kind of in line. But we are trading underneath, like let's say 0.5 times like this overseas REITs, they are trading at steep discount to your asset value. And this is Parkway Life. So Parkway Life is like 1.6. So this is kind of overvalued if you look at it from that perspective. And this dividend yield means that it could mean that because the share price crashed as well, which is why it's paying so much dividend yield, but it also means that it is towards the right side is cheaper. So from what we see here, this area are the US listed REITs. I mean the REITs with US office assets. So right now the US office assets, they have a lot of headwinds. As you see, every now and then there's this news on US office where they say, oh, this asset manager with US assets is defaulting and whatnot. But mainly it affects assets in the gateway cities. So like you see for Manulife, they have Figura, one of their assets, which is in downtown LA. So which was why they were hit quite badly when they saw like 33% devaluation of their assets. So which is why also they are trading around this cheaper area here, and the sentiment is just very bad for them. That's why they are trading around this cheap area. But what you can notice from this graph is also that there's a lot of the Singapore REITs are trading around 1 times book. So as you can see, the bigger players like Maple Trees and the Capital Lands, they're all trading around 1 times book and around 4 to 6. So that is the trend now for a lot of the local REITs. And for the next slide is the sensitivity analysis for 1% rise in interest rates. So what this means is like, for example, Prime US, when interest rates, like the base rate rises by 1%, their DPU will be affected by -1% because they are hedged, 86% of their loans are hedged. But if they are unhedged fully, they'll be affected by 8%. So we are trying to show that the hedging is very important for these REITs. All these REITs were chosen, not say by random, but by subsector. So it's just a proxy to the subsector, like MCT is retail, WDC is data center, this is US office, and etc. etc. But going forward, it's very challenging for REITs to have a hedging strategy, because when the rates are starting to peak, as a REIT manager, you might not want to hedge, have a very high percentage of your loans on hedge to fixed rate, because if you hedge it at such a high rate and then the Fed rate starts to lower the interest rate, right, then you're kind of locking in a higher rate and higher interest expense. So it's quite challenging, as if you might want to unwind your hedges, also there are some costs involved. So it's quite a challenging time for REITs at the moment. And of course, with the high interest rates, it's still challenging for REITs to do any acquisitions, as seen in FY22, where a lot of the REITs, there are basically no transactions, very few compared to 2 years back. And this is probably the same thing going forward as well. So for subsector perspective, we are still, we favor the hospitality sector, mainly because the recovery in the travel and the recovery in RevPAR will directly affect the top line of the revenue of all these hospitality REITs. So this is the hotel RevPAR over visitor arrivals graph. In this graph, you can see that as of last year, the RevPAR has already overtaken the pre-COVID levels, especially in the fourth quarter last year, where there was Formula One, etc., and a lot of the high demand. So that's why we see last year in December, it was an all-time high for RevPAR. And then, of course, in January, it did, because it's not the holiday season anymore, but no doubt it's still higher than pre-COVID. And what we're trying to show here is that despite the RevPAR already being over pre-COVID levels, the visitor arrivals is still 20% below pre-COVID levels. So when we expect that the Chinese travelers, when they start to come in again in the second half of this year, this will probably go back towards pre-COVID levels, and that will help to boost the RevPAR even further. But we are still seeing some weakness in the Chinese travelers returning for the first half, because there are some visa issues and whatnot. That's why, and we've spoken to some of the hospitality REITs, they said that there's no tour groups for China yet that's coming into Singapore. So this we anticipate probably in the second half of this year. Yeah, so that's all for me from the REIT sector. I will hand over the time to Paul.
Okay, thanks. Thanks, Aaron. So I'll be covering banks. It's me again. Okay, it's not that we have no budget for banking analysts. So our banking analysts have a personal matter. So I'm just acting as the banking analyst. Okay, so so for the banking sector, the main theme we think will be net interest margins will continue to grow. So for those who know, net interest margins means how much they charge out the housing loan borrowers and how much the poor returns we get as depositors. So that's the spread. So from this chart, what we will see is that the first point is that US interest rates, which is the dark blue line. Oh, sorry, I should use pointer. The dark blue line continues to rise in line with the light blue line. So first point is that US interest rates and Singapore interest rates move in line very closely. I mean, if some of you want to go and do some stats, always about 98% correlation. Actually, so it's very tightly. So the second point is that banks, whenever interest rates rise, the banks' margins will also rise. Okay, so although second half you notice the bank earnings, their interest income can grow like 40% like a tech stock. But we think the first half you should also see another very strong earnings from the banks, mainly because the margins only move in the second half. So you have another 12 months. So and SORA actually sadly continues for those who have housing loans. SORA continues to rise, so to get ready for your notice anyway. Yeah. So what you see is that what we think is that bank margins will continue. It took a 32% basis point rise, that means 0.32, and the margins we think for banks will continue to increase again for 2023, and then maybe stable or drop a little bit in 2024. So that's why we think bank earnings will still be very strong at the very least in the second half. Okay, the reason why the banks are earning so much is mainly because of this. CASA is the current account and savings account that it charges, which we earn nothing anyway. We call it the golden goose because so basically it is like, so if you don't think of deposits as loans, deposits are technically loans from us to the banks. So if the banks, you look at the little box on the far right, is to give you stats. Actually, it's for me to remember. I can't remember all the numbers. But so what it tells you is that the DBS has 300 billion of CASA. And basically, this is zero interest rate loans that depositors give to them. Of course, if you give me zero interest rate loan, I also can show you a good time. But for the banks, they get this, and then they can charge all the housing loan borrowers at higher interest rate because these are variable. So the first way they make money is, of course, they will collect this and they can park it into the interbank, and if not, they can also park it with housing loans, and then they have variable rate loans. So the loans, when interest rate increase, they can charge housing loans. So that's why we just want to remind you that's why the banks will continue to enjoy very strong margins, because they got this huge golden goose, which is the CASA deposits, which is zero interest rate loans or deposits technically. Okay, then the other thing we wanted to, because this came up in the news so much, SVB means Silicon Valley Bank, then Credit Suisse, and then Singapore banks. So this is just a summary of the three banks in case you're worried and you start to queue outside the branch. I tell you, don't need to. But firstly, okay, so in terms of the first portion here is actually the capital ratio. So actually, the capital ratios for all these Credit Suisse, actually they're quite similar to a Singapore bank. It's a bit scarier, but what it does mean, they're all three banks are all very well capitalized. But the difference here is, at least for Credit Suisse, you see here, Credit Suisse they made a lot of losses because they had a few accidents. Let's call it a nicer term. There are a few accidents. They had a few very big lumpy loans, and they had 2 years of losses. So that's the one difference. For the Silicon Valley Bank, you can see that for Singapore banks, they don't have that much in securities. So for Silicon Valley Bank, that means they take all the money from depositors, they put it, I guess became like technically like a hedge fund. They just put everything into government securities, whereas Singapore banks don't have so much of it. So that's one of the reasons why the Singapore banks, although interest rates came off, they also have these losses, but it's not as severe as what we see in Silicon Valley Bank. So just wanted to show the difference. Okay, so I'll just move on to the other sectors. Somehow it's me again, but okay. So the sector that we like is, of course, construction sector. But of course, it wouldn't play the contractors because it's so competitive. But what we like are the building material companies like Penn United or even BRC Asia. So why it's different this time, which is something we all shouldn't say, but it's really different this time. So so if you look at this blue chart, so this is the amount of construction contracts awarded. That means public sector, government, the developers give to the industry. So you notice it's like a yo-yo, some years good, some years like feast famine, sometimes Chinese New Year good, something. So I'm not trying to say it's a very extremely volatile, but you'll notice that from 2023 onwards, it's all going to be quite steady. And this from BCA, and then BCA's calculations are very accurate. It's like 40 point something, because they've kind of, so their forecast is usually very accurate. And the reason why is that on the the box on the right, it's just for me to remember, is that of this thing called Singa bonds by the authorities. So what has happened is that in order for us to spend more in construction, we took it off balance sheet in a way. So in the government budget, right? So that part here is what the government budget is. So the government is actually spending 2 billion in infrastructure, but they are not putting into the budget. They're taking it out, and they're going to take out almost 90 billion of it. So that's why construction is going to have a pretty good time the next few years, because these are all not in the budget. Because budget is usually it limits the ability to spend on construction, but all these are taken out. It's called Singa. If you have time, you want to go and read it out. I've also forgotten the acronym, significant infrastructure. But what it means is that they will only put it all back into the budget through depreciation many years later, and also through interest. So that's why the government, the authorities are able to spend a lot more on construction, and that's why the next few years construction industry will be better than expected. But we prefer building materials because their market share is 40% and above. They don't have to compete so hard. So for semiconductors, for us, we are in a downturn right now. I think if you know anyone on semiconductor, the issue right now for electronics is basically two things. Because customers right now are worried. So at most electronic companies, 9 out of 10, I think the only one that didn't guide down was probably Aztec. But 9 out of 10 basically tell you two things. Number one, customer orders are coming down because they're also worried now demand is coming down. I told you there's a lot of inventory in the US. And then number two, they are also not doing new launches because they're worried about demand, and because of the old products cannot sell, they cannot do new launch. So all these are affecting a lot of the contract manufacturers, the semiconductor companies. So in a typical contraction, again, no one can tell. I can't tell you September the 14th, 2023, that will be the bottom. I have really no idea. But historically, the contraction, that means the downturn, is usually maybe 12, 13 months, and we're already halfway there. So maybe by year end, semiconductor can come back up. But our last word for semiconductor is just be prepared for growth. That means do prepare to come back in. This time round, the Singapore listed semiconductors companies might come out even stronger than before because of what's happening out of China. So a lot of semiconductor companies are coming to Southeast Asia to expand their supply chain to get ready for the next cycle. So a lot of the semiconductor, I think UMS or whatsoever, all have new customers. So when the cycle comes back up, they will be even stronger than before because they have a new customer. And most of them are moving to Malaysia and Singapore. Maybe I should ask, but they go into Johor, especially because they want to stay in Singapore, they can monitor, right? So, but anyway, a lot of the semiconductors are coming into Southeast Asia. That's why the next wave for the Singapore listed ones, or even the Malaysian listed ones, the wave can be even stronger because they all got new customers. They're all ready for the next wave. But just that in a very short term, you'll see this weakness. Okay, so for property, most of you probably know better, but let me just share you my view. It will not be as vibrant as 2022 for the single fact that last year there was like 4,000 new launches. This year there's going to be 11 to 12,000. So it's like 3 times more. So we think prices will probably be low single digit. New launch, you won't get like weekend all sell out, such fun times, but you probably get 30–40% in the weekend. The next one coming out is the Busu Grand, so that's probably something to watch. Because if you ask any developer, when they buy a piece of land, what they think of demand, they frankly don't even know that. I mean, they have to actually watch, they actually monitor each launch, the vibrancy, because it's very hard to compute. You can't do a spreadsheet and think what you think is demand. They virtually monitor each launch. I mean, if you ask the developer, they virtually have to monitor each launch, see the take-up, see the amount of people in the showroom. So that's how you gauge very near-term demand. There's no spreadsheet to tell you. But anyway, we think it was not as vibrant as 2022, but one of the things happening is that the inventory is low. So the average inventory is 2.6. It's a bit high now, but because you're comparing to sales, but the inventory right now is about 16,000. It used to be about 35,000 inventory. That means these are projects that have been with planning approvals and so forth, but either not yet launched, already launched, but not yet sold and so forth. So the inventory out there is about 16,000 right now. So the inventory is still pretty tight, but it's just that you need to watch the sales through, because so far the first 2 months have been quite big. Okay, I think this will be our second last slide for sectors. Then before we move to stock picks. So for telco, apart from neutral, it would be like nothing to see here, virtually what we mean by neutral. So if you look at the profit, so it's structurally going to be big. So if you look at the earnings, so this is the profitability of Singtel and StarHub. So StarHub is in blue, Singtel is in red. So you can see it continues to slide down. So let me just tell you the problem for each. So for StarHub, actually this year should be a good year because roaming, all of us go to Johor. So roaming should be better because roaming is a 100% margin for business because there's virtually no cost, right? When you go over there, it doesn't cost StarHub anything. They just ask the partner there, they share a bit of revenue for the partner. But what's happening is I think StarHub is undergoing 200 to 300 million restructuring. So that's why the earnings is going to be low. It should be actually very strong because of roaming. It's coming down because they need to revamp the IT. I'm not sure what system they use. Hopefully not the same as DBS, but what they're saying is the system continues to be weak, and so they're trying to upgrade the system so that they can generate more revenue. So that's why even this year the earnings is going to be pretty poor. And of course they also spend on EPL content, which okay, I don't know comment about it. Then the other thing is for telcos, even Singtel is also doing is performing poorly. India is doing very well for them, Bharti, because competition has kind of stabilized. But I think the one that's giving Singtel, the one in red, weak earnings is mainly because of Australia. Optus earnings continues to be very weak. I won't go too detailed here because there's this thing called NBN. But what we're trying to say is that really structurally telcos very weak, even though they have 5G, but 5G just your YouTube is 2 seconds faster, doesn't really matter. So they're going to spend a lot on 5G and they're not generating enough revenue for it, apart from gaming and so, which is incremental. So that's why telcos is a neutral for us because the earnings is just so quite sluggish. The upside for telcos is that they're going to IT services. So I think maybe I'm not saying give up, I'm just taking the extreme here, but the catalyst for telco is there's going to be consolidation. So the StarHub will be a good, interesting play if there's consolidation because we have too many operators here. We have 4, right? So if we probably shrink it to 2 or even 2 at the minimum 3, then I think StarHub might be an interesting stock here. They have a minimum 5 cents dividend. Okay, we get a lot of questions on Bitcoin, gold, so let's give us our views because please don't this is just our views. Before we start on Bitcoin, just the usual MAS disclaimer. Bitcoin is not a medium of exchange. Bitcoin is not a store of value. Bitcoin is not a unit account, but it's definitely a fun speculative instrument. So actually, if you look at this chart, GBTC is one way to get exposure to Bitcoin through a trust. That means it's listed in the US. I think this year it's up about 80%. It's not an ETF, it's like a closed-end fund. The other one is, of course, gold, your GLD ETF, which is in orange, and TLT. So for us, if you want to play or you want to gain exposure to lower interest rates, I guess one of the ways, but this is a very aggressive way to play lower interest rates, is TLT. Basically, you're buying 20-year bonds. Gold, we think, will also benefit if interest rates come down, but the benefit of gold is meant to take, it's like an insurance policy, when certain deflationary shock, negative events happen, gold usually spikes up. So gold in a way already, you already claim your insurance anyway, so we're just a bit more wary of gold. We think there are other ways to play that. But again, Bitcoin, do notice the disclaimer. Okay, this is my last slide on sectors. So we don't meet a lot of companies. I think for lunch, for meetings, they meet virtually many meetings. Of course, we don't cover every sector, every stock. Some might be too small, some we don't might be too small, and some we just don't cover. But these are for meeting so many companies, these are the sectors that have momentum. So some of the areas that we see is like, firstly, China travel. Of course, we all know things are opening up. Now, of course, to buy a China reopening story to Singapore is like an oxymoron, right? You want to buy China, of course, you buy Hong Kong. Why want to come all the way to Singapore to buy a China story? But the one thing unique for China Aviation is that it's a very, so for China Aviation, they have a petrol kiosk in a way in Shanghai Pudong Airport. It's like your petrol pump, and there's only one petrol pump. If you don't want to pump, then you just don't fly out of Shanghai. So because of that, you have a captive, so your margins are very secure, and of course you have the only petrol kiosk there. So if you want exposure to the recovery in outbound travel, that means tourists coming out of China, and of course Shanghai is the main hub, then China Aviation will be one of them, because their profit is about, this year they made about maybe 20 million from Shanghai Pudong. At the peak, they make almost 80 billion. So the earnings can, for that, Shanghai Pudong can maybe double or even triple. Another way to play is, of course, China consumer. Of course, there are many ways to play China consumer. You go to Hong Kong, there's probably a whole list. The only difference we can say for REIT is that because they own GTO, that means they take a percentage of the tenants' sales. The only difference is that whatever they take, they actually pay you back as dividends. So you don't have to wait through the share price. They actually give you a yield. The yield, of course, looks nice, but there's a bit of support from the sponsor. Probably the yield based on the actual performance, about 7%. Another way to play, of course, if you like J Chow, then you just play JHY, because they want to arrange all the concerts. And in China, it's not about the demand of concerts coming back in China. It's whether you can get the space, because they're going to raise price. There's just too much demand. There's not enough space to hold all these concerts. Of course, we have shipyards. What we have happening now for a lot of the shipyards is the FPSO boom. I won't go to detail because some may not truly understand. Of course, another sector that's doing well is all the vessel owners, because of oil price higher and renewable spending. Okay, I'll move on to our usual model portfolio, some of the changes that we did. We did quite a major revamp. We took out a lot of the mid-cap names because so for us, we added FCT mainly just to anchor it as a REIT. We added in Propnex, we'll talk about it later, and then we added in CapitaLand Investment. We took out Prime US. Again, these are not that we downgrade to sell. It's just that for me, I think Prime, we just worry of the headline news. Because what happened to Prime was in January, they did very well. They were up, I think, 18 or 20%. Then when the Fed decided to maybe raise, there were talks of them raising interest rates. So they got hit there, and then they got hit again because of all these banking things. So we're just worried of the headlines coming up. The Monte results was a disappointment. We still have a buy. H1 just everything in short term, just a bit slower. These are the changes that we made, which we will just run through later for you. So this is the performance. So we always have a quote at the bottom here, which that means, again, this is just for illustration. Of course, the performance is so bad you take into account dividends, but we know this is just for illustration. And of course, the comment there, if I'm actually a fund manager and I go to the client, this will be the comment for the client. Please no more mid-cap names, because Del Monte was down, I think 20, and also Prime also down. So these were the two that pulled us down quite significantly. Again, this is just for illustration. Okay, I'll hand it over to Darren to talk about some of the REITs.
Yeah, thanks, Bob. So one of our calls for our Phillip Top 10, Phillip S10 is CapitaLand Escort Trust. So this is based on the recovery of RevPAR. But right now we see that the RevPAR is at $155 and it's almost at the pre-COVID levels already. But then by this title, we mean RevPAR back to pre-COVID. We do not mean that, since it's hit pre-COVID, there's no more room to grow. What we mean is that actually there is still more room to grow because it has already hit pre-COVID levels, but without the Chinese travelers. So when the Chinese return in probably the second half, we expect this RevPAR to go even further. So that's one of the reasons we like Escort. Another reason is because right now they have about $300 million that is still in their books that is divestment gains. So they have this track record of divesting assets above their valuation. So there's some hidden value in this hospitality asset that they have. So with this $300 million of divestment gains, they can use this to acquire further assets or even distribute as dividends in the future. But they did not distribute any part of this $300 million in this FY22, the full year that just passed, because they had some good recovery in the REPA, and just from the top line alone, it could cover their usual dividend payments. That's why they didn't pay out this quarter. And another reason we like them is because of their split between stable income and growth income. So right now, for the second half of 22, their stable income contributes about 52% and 48% from growth income. So we like this split because there are a lot of uncertainties going forward. And let's say if with perhaps another strain or whatever, a COVID strain, then this stable income can help to keep the base for escort, while the growth income can to pay for the recovery in the REPA. So those are some of the reasons why I like escort. And for escort, we have a buy rating. The target price is $1.26, and with a DPU yield of 5.7%. So our next pick for REITs is Fraser Centrepoint Trust, FCT. So one of the reasons we like FCT is because they have a stable, their tenant sales trend is above pre-COVID levels. It's been there for about 1 year already. And we expect this to continue going forward. But the growth maybe will slow down a little bit, but we still think it will maintain above pre-COVID levels. There are some headwinds there, like the increase in GST from 7 to 8%, but we still think they can maintain their tenant sales above about 5% above pre-COVID levels going forward. So that's one reason. Another reason is because they have ancillary income, which is car park income and atrium income. So pre-COVID, 5% of their top line revenue is from this ancillary income of car park and atrium sales. But then because of the lockdowns and whatnot, they did not have this at the first quarter of last year. So this started coming, ancillary income started picking back up towards the second half of last year. And the ancillary income will contribute to the full year going forward. So that's another reason. And the third reason is because right now for FCT, the occupancy cost, which means the rental income you pay over the tenant sales that the tenant makes, is at 16.2%. So pre-COVID, it was about 70%, and during COVID, it was 19.2%. So what this means is that your rental you pay is actually lower than pre-COVID, which is based on your tenant sales. So your rental you pay on your tenant sales is lower, the ratio. So it means that there's a lot of room for FCT to actually increase the rental that they can pay, that they can charge the tenant. So there's a lot of potential for higher rental reversions going forward. And for FCT last year, they also mentioned that they announced that they acquired a portion in Next, and that's a 25.5% if you take into account everything. So what happened last year at the first quarter rather is that together with their sponsor, Fraser's Property, they acquired a 50% stake in Next, and then FCT owns 51% of that stake. So altogether, they own 25.5%, but this is based on, because they invest in the investment vehicle, and so we are not quite sure whether this is accretive. So we think we are still neutral on the deal, but we think it's a good strategic fit for FCT because their assets are all large suburban malls, and Next is one of the largest suburban malls in Singapore. And this deal was actually done exactly at valuation for Next. So the acquisition price was actually at valuation. So we are neutral because we are not quite sure the utility cost that Next that a vehicle will be we are neutral on the cost for the utility cost rather. We are not sure at the vehicle level what the utility cost is. Yeah, that's why however, we are still accumulate on FCT with a target price of $2.31 and a DPU of 5.5 cents. I think that's all for me. I think I don't want to recall.
Okay, thanks. I'm obviously talking too much, but okay. So the next part that we like is city development. For those who don't know, it's a property developer. And they also have hospitality. So the two reasons why we like it is because of the tight inventory. At least they are one of the few that a lot of units to sell. They're almost like 2,000 in the pipeline. And of course, one of the best ones they have is going to be the relaunch of Fuji Xerox. So why we say it is the best is that Fuji Xerox building, it was an office building, then they converted it into service apartments, into residential, and they got a free gift from the authorities. They got a 25% increase in plot ratio. They always refuse to tell us what's the cost, but we think their next lot, their redevelopment of Fuji, sorry, not in the slide, will also be a very high margin product. The second reason why we like CDL is because of just the whole hospitality recovery. No, so we've already seen the wave. There's still going to be reopening effect for Singapore. We need open in April, so maybe this first quarter you're still going to see some good numbers. And like we said, now we're still going to get the wave from China. Just that it just takes a bit of, probably be at the year end. And we've already seen some of the improvement in. So RevPAR is basically your revenue times occupancy. It's just a fancy word to say of room rates, but with some occupancy to be computed here. So this is the reason why it's under review, because the transition of changing the analysts. Okay, of course, DBS, even though they should have used, shouldn't use maybe should have used Silver Lake software instead, which we have a buy to. Okay, so for DBS, we still think you're looking about 13% growth in earnings for this year. Of course, names that we mentioned, interest income will grow. The unknown is virtually what you see on the chart here, fee income. So fee income, which is what they earn from the investment banking, from wealth management, that came down because last year the markets were so poor. So that's why the fee income, you can see in the blue line, actually dropped. But we think that will also can recover this year as capital markets stabilize and you can get the growth back in. So for DBS, we're looking at mid-teens earnings growth. But the one we prefer is actually also, is OCBC, because they are paying around almost I'm just going to round it up, almost 6% of dividend yield. And this is their audit related, nothing to do with special dividend. So in the past, and even after paying 6% dividend yield, they still have one of the best capital ratios in the bank among all the banks. So they still have a lot of capital. I think they are playing a soccer match with maybe 3 goalkeepers, so they're very defensive compared to the other teams, other banks. So we still like it. They were a bit weak, I guess, in 2022 because UOB performed better last year because they didn't have China, and at the time China was locked down. So most investors prefer to buy UOB, because they do not want to get the China exposure. But right now it's the flip. Now everybody wants the China exposure now because of the reopening and recovery. And do remember, when they pay you this 6% dividend, they're only paying you out of the 50% of their profits. I mean, when you're talking to a REIT, REIT pays everything. They pay 90% of all their earnings. So at least for a bank, we think that they can still grow because they're obviously only paying you half their earnings and the rest is deployed to grow the business. I think when things, economic growth slowing down, but it's not, you might see a bit of higher credit provisioning again, but again, they're going to still enjoy, I think about 15 or mid-teens kind of earnings growth for us. So that's why it's going to be quite rare to get a buy a bank, that's almost close to 6% dividend yield. The other thing is, we like SGX, not because they got so many new listings, obviously it's the reverse, it's more privatization. But we like SGX because they are also going to benefit from higher treasury income, which is a fancy word for interest income. Okay. So what we do, just to give you a flavor, so you see on the box here, FY20, they make a lot of money from interest income. How they make it is because of the float that they get. I think they got a 14 billion float, which you won't see in the balance sheet. So when you are running a derivatives or XRG, you have all the clearing members, those who want to trade derivatives, all have to put money with the SGX. Because otherwise, if they cannot pay, then SGX will bear the bad debt. So SGX typically has a 14 billion float, which they actually earn interest income on. Of course, they do share with the clearing member, but they also take a cut of it. And of course, they take quite a big cut. You can see in FY20, they made almost 135 million on interest income. You can see on the chart here, this is what they made. And this is even when the Federal Reserve, when interest rates were very low, which you can see the SORA here was only, I think, less than 2%. They already made 135 million. And now with SORA hitting 3.5 and more, I think most of it is in US dollar deposits. So we also have the Fed rate at the peak last time, 2.5. So what we think is that interest income is going to surprise. You already see some of it. So in the FY22, they made like 450 million from interest income. But in the first half, they already doubled that. So they made in the first half alone more than what they did the whole year on interest income. And this is big because if they cross 100 million to even 200 million, and SGX typically make like 400 million a year. So this will give them at least a 10 to 20 percentage points of growth. Volumes, nobody can predict. I mean, none of us will know how the volumes will trend, but at the very least, we know that they are one of the beneficiaries for the other beneficiary for higher interest rates. And you know, SGX is a monopoly, and the derivatives, the good thing for them now is the derivatives, because derivatives now can capture global flows. Whereas, you know, in Singapore, if you're talking about SGX, it's, you know, virtually a domestic flow. But now that they are expanding so much to derivatives, into FX, into bonds, they can catch the global flow, and that's why we still like that. And their ROEs, I think, more than I think the high 20s or 30%, if I'm not mistaken, since I'm not the banking analyst. Okay, the next one we like is capital land investment. So firstly, just to recap on the model, that's why we have the title here, real estate cradle to grave to afterlife. So let me just explain a little bit what this means. So the unique model that capital land investment has is that they can, okay, I'm taking it to the extreme here. They can virtually take an empty piece of land, they will build a mall or office or sales department, and then they will tenant it out. So they will put all the tenants in. And then they will, this is what we mean by cradle. That means they can take a greenfield project, develop it, fill it up with tenants, then they can sell it. That means go to the grave. I mean, another word. Okay, go to the grave. That means they sell it and then they make money. They make a gain from it. After they make it, even after the afterlife, they can still make money. Is because this asset will be sold to the funds that they manage, like REITs. So after they sell the property to a REIT, they will still become the manager and they still earn money even in the afterlife. Basically, they don't give chance anyway. So this is a very good model, but it's of course very hard to replicate because you need to set up funds. So if they don't sell the property, let's say they build a mall, if they don't sell it to a REIT, they can also sell it to some of the private funds that they set up. This model is great. I think most people will know about it, but it didn't work last year because the interest rates were skyrocketing. Who wants to buy any asset? You're not sure what would be the interest rates. And of course, a lot of their assets are also in China. So that also affected them. But right now, with interest rates a bit more stable and with China reopening, this model can now generate the kind of earnings growth that is meant to be, like, that's lack of a better word, but for instance, China used to be like almost 30% of their earnings, but because of the downturn, it's only 10%. So if China bounce back up, they'll get this big jump in earnings. And the one difference that they do, okay, so the chart here, FRB means fee-related kind of revenue, and then the other one is real estate revenue. So fee means they make fees from running all the REITs that we own, and of course from the private funds. And always remember that the best type of income is actually running a real estate is the best kind of fee because it's very permanent, because you can hardly sack, no matter how much you don't like them as a REIT manager, unless you have more than 50%, only you can sack them. So this is not like, you run a unit trust, or some years your funds can go up and go down compared to the market. So this is a very sticky, very high quality fee because it's very permanent capital that they earn. So that's the other attraction why we like. And because things are opening up, their whole model is extremely hard. Most developers will find it hard to develop, because especially on the afterlife part, because they have to set out a lot of private equity funds, and you have to attract global capital again. So that's the strength of the capital. That's why we like capital land investment. The other one is Keppel Corp. Okay, I'm not the analyst, but again, so we really know what happened to Keppel Corp. There was a big jump because they finally got, after keep talking about it for almost a year, they finally managed to sell off Semiconductor. So what's next for Keppel Corp? Admittedly, the story ain't that exciting as when they had to just sell it up, because in future, most of the earnings has to depend on selling property, which isn't such a nice story. But but one thing good for Keppel is that they have a huge pipeline. They have like 40,000 units, mainly in China and Vietnam, to sell. And then they will, the whole model now is to sell all these units, probably about 4,000. So they got almost a 10 years of units to sell. or pipeline, and then they will take all this money and then they will reinvest into utilities. So I'm not sure it's going to be like a Semiconductor Industries mini-me, but anyway, that is the game plan, to take all the proceeds from property and then reinvest it into utilities and grow their business. So that's the outlook for Capital Corp. It's mainly residential. Of course, they also have M1, but it's so insignificant, it's not worth even mentioning it. They probably have to kind of sell it back to StarHub or some sorts. Okay, so the other, okay, I know everybody's like, oh, this company again. Okay, but anyway, you still like Comfort after 20 years. Okay. So for me, Comfort Delgro for me is not only just earnings recovery story, it's also a balance sheet. So for this chart, you'll notice the red line is actually the profit, the PATMI, and the blue line is the balance sheet, the net cash they have on the balance sheet. So why we liked it, okay, maybe don't like the share price, but I think why we like the fundamental story was because there was a recovery in the earnings. You can see from the red line. This year, they were affected mainly because of what happened in the UK, of all the bus strikes. They had to pay the bus drivers higher, and you will get the repricing in 12 months' time, but the timing is unknown because it depends on every contract. They also got hit by the higher bus contracting. But what will carry the earnings for this year is, of course, there's more volume, more people using the train. And of course, there's a repricing. Some of you may not realize, but actually all our bus fares has actually increased, I think by 20-odd%, if I'm not mistaken. Just that most of it is going to be subsidized by the authority, but they will get this increase in fares. And so what hurt them was also China, because China lockdown, they had to give almost 15 million of rebates, and all this hits the bottom line. So with the reopening, we think the earnings can recover. The other story was that there was also a balance sheet story for them. Pre-pandemic, they had net cash of 64 million, and when they came out of the pandemic last year, they had almost 600 million of cash. Of course, nobody cares. We'll just look at the earnings, but that's why we liked it, and we think the recovery is still on track. The other one, this is probably the last, okay, so for once we're ahead of time. So the other stock we like is actually Propnex. The reason is, of course, they have a 7% dividend yield. Actually, nothing much to talk anymore. I can just move to the next slide. But why we like it is because to pay 7% dividend yield, it's probably about 40-50 million of earnings, which they more than cover from their normal operating cash flow. But their balance sheet has more than 100+ million of cash. So they have a lot of cash to kind of sustain the dividends. We were actually very surprised their earnings sustained. So Propnex is a real estate agent. So you can see that even though transaction volumes, it's a bit hard to see, you will notice the red line, which is the amount of volumes in the primary and secondary. So this is the new launcher, secondary homes. It actually collapsed. So we thought their earnings were actually going to come down because volumes are down. But they managed to capture a lot of market share. It also helps because they actually raised the number of agents, I think now 11,000. So of course, there was another reason why they managed to sustain the earnings. So the earnings is actually the blue line. So what we're just trying to say, even though when volumes came off so severely, they managed to maintain the earnings by maintaining the market share. And in 2023, see the red line here, we expect a rebound. Like we told you, new launches will jump from 4 to 11,000. Secondary will probably be stable. So there's at least more products for them to sell. Because last year there was only 4,000 units. So the number of units was collapsed. So that's why we think volumes will go up. And for us, basically, there's a visibility in earnings. So we can see the visibility because the volumes should be rebounding in 2023. And again, they have one of the best business models out there, just like HRNet. Their ROEs are maybe 30-40% because there's virtually no fixed assets in this business. I know there's a few computers, maybe they rent a house, they're not, I mean, I'm just exaggerating, but they just have to rent a premise. So it's a low barrier to entry, but the barrier to scale is the most difficult. That means anyone can go in, but can you hit 11,000 agents in scale? And their biggest strength is actually new launches. Because when a developer launches a new launch, they normally only take 2 or 3 developers. They're not going to take the 10 or 20 property agents and use. So they only use 2 or 3 agents at most. And usually, of course, Propnex has about 40-50% share. So that's why you can imagine you have a business in Singapore where any new launch, 40% of your business is gone. So that's one of the strengths of them, and also in the VHR net because of the asset like high ROE. Okay, so after speaking for almost 1.5 hours, I think we just come to the conclusion, and then we can, at least this time around, we have a lot more time for Q&A. So the conclusion, since everybody forgot what I just said, so what we think is that the economic conditions will be slower, and we think, again, my probability, if anyone's listening, is a 60% probability of US recession. We think interest rates have peaked. Maybe one more rate hike, but we seriously doubt it because you're going to push the bank's balance sheet even harder, which we think the Fed may not want to do that. Singapore economy is resilient. We still favor banks. We know REITs, technically we like REITs. Why we say technically is that the whole model for REITs is about it's like an interest-only loan. So even though interest rates may come off, but it's still going to be high. So even though the REITs, like Darren mentioned, have hedged for 3 years, when a REIT say they hedge for 3 years, it also means they're going to face 3 years of higher interest rates because they're going to 1/3 of the loans they had at very cheap rates now have to go up higher. Another 1/3, another 1/3. So we don't expect dividends for REITs to climb, but we think when interest rates coming down, technically we like REITs. But again, when you have a model that's relying on capital and cheap capital, structurally there's always going to be a bit of issues there. But technically we still like REITs. Okay, I think we come to the conclusion. I think we can move on to questions if you have anyone has.